Hello again, this is Dr. Lindsay. And in this video, I'm going to go over the practice handout on the Federal Reserve. So the first question, draw the money demand and money supply diagram and show the equilibrium. So we've got interest rates on the vertical axis, the quantity of money on the horizontal axis. We've got a downward sloping money demand curve. And we've got a vertical money supply curve. And the equilibrium is right here at this interest rate, I star. Suppose the Federal Reserve wants to decrease the money supply. We know what's going to happen. Decrease in money supply will shift this money supply curve to the left, new equilibrium, and interest rates will go up. Will it buy or sell US government bonds? Now remember, to increase the money supply, they print up money and buy things. And those things are usually the US government bonds, which they keep in their portfolio. If they want to decrease the money supply, they do exactly the opposite. They sell these government bonds that they bought, issued by the US Treasury. They sell them for money and bring that money back to the Fed where the money can be held or destroyed, thereby decreasing the money supply. So they will be selling things. Those things are usually the government bonds. What will happen to equilibrium in the money market when the Federal Reserve decreases the money supply? Well, we've shown it, the interest rate is going to go up. What will happen to the money demand curve when the Federal Reserve decreases the money supply? Nothing. The money demand curve does not change. There's just been a movement along the curve upward to new equilibrium point. Will this have an effect on the interest rates in the economy? Absolutely. The interest rates will go up. Now, use the short run model of aggregate demand, aggregate supply to determine how this will have an effect on the economy in the short run. So on aggregate demand, aggregate supply, we've got some aggregate supply curve that is upward sloping, something other than vertical in the short run. And we've got some downward sloping aggregate demand curve and some equilibrium level of real GDP and an equilibrium level of inflation. Interest rates going up by the Fed slows down the economy and decreases aggregate demand. So this aggregate demand curve then will shift to the left. A decrease in aggregate demand, new equilibrium, and you can see that output in the economy, real GDP, will fall. And depending on how flat or steep this aggregate supply curve is, inflation will fall a little bit too. Inflation is much slower to adjust, though, than GDP. The GDP tends to adjust very quickly. Prices adjust much more slowly. Next question, use the long run model of aggregate demand, aggregate supply to determine what effect this will have on the economy in the long run. Well, in the long run, the aggregate supply curve is vertical at potential output, because in the long run, we're going to be on the edge of the PPF at full employment at potential GDP. So a shift to the left of aggregate demand because of the rise in interest rates means that in the long run, the only thing that's going to happen is that inflation falls, but output will be the same. The long run will be back on the edge of the PPF. And that makes sense that the Fed decreases the money supply And eventually that has an effect by lowering the inflation rate.